Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/Rive to receive the top 10 stocks to buy right now. Disney has not been a favorite of investors over the last year, losing almost half of its value. But I think this is a company that's still well positioned for the future in streaming and entertainment. And I want to explain why this is still my top streaming stock right now. When thinking about Disney, I always go back to what's called the smiling curve. So this is just simply a chart with a line that shows a smile, pretty simple concept. And this smiling curve really shows Disney's strategy when it comes to content. So if you look at the vertical axis here is the value of content, and the x-axis is the cost of that content. You can imagine there's a full spectrum here, but if you look at Disney's properties, they really trend towards either really big blockbuster movies, so the Pixar movies, Marvel, Star Wars, and then some of the Disney studio movies as well, or TV shows that are rewatchable over and over again. It's Always Sunny in Philadelphia, Puppy Dog Pals. If you have kids, The Bachelorette. These are really time fillers when you think about a streaming service, but that makes them really valuable. If you just have hit movies, there's kind of a limit to how much time you can spend on any given streaming service. But if you have all these shows that can fill hours and hours of time, just when you want to watch something, that's a really good place to be. That's something that Netflix has really struggled with. Disney has a lot of content that fills both that time filler slot on the left and also the blockbuster slot on the right. So I think that's a really good position to be in. If you go further into their business model, they operate what I would like to think of as a waterfall. So I took Marvel movies as an example here. And the numbers that I've associated are the best approximation that we have from their recent income statement. This is for the first 3 quarters of fiscal 2022. The box office and related licensing generated $6.4 billion in revenue. Linear TV and streaming generated $36.7 billion of revenue. They don't directly break out things like merchandise, but there's obviously a piece of those first 2 that's going to be there. And then theme parks is a huge business for Disney, $21.3 billion revenue there. So Disney can create a piece of content that's really high value on the top left there and continue making money from it year after year. We've seen this with the Marvel movies. We've seen this with Star Wars. They have rides in their theme parks that are based off of those movies. So they continue to generate value year after year. And I think this really goes back to this smiling curve here in the top right. This is really where Disney is the most comfortable making blockbusters. They're better at it than anybody else. And then they have that filler content on the top left as well. May not be the same household names, but if you're in one of these niches, that can be really valuable for viewers if you're trying to pick which streaming service you're going to cut. Disney's probably not on the top of that list. Now, one of the challenges I think investors are having right now is Disney's moved from linear TV and the profit center that was to streaming is going to take some time. There's a lot of investment that goes into not only the technology, but also building out the content that isn't going to be monetized in the same way. So the stock looks fairly expensive at a PE ratio of about 56. But if you think about that as an investment in future growth for the company, both on the top line and the bottom line, I think this is the right move to do. They have the right content strategy, that smiling curve that I mentioned earlier, and then the waterfall strategy with being able to monetize content in multiple different ways over a long, long period of time. That's why I think this is a company that strategically is really, really well positioned. I don't know if the stock is going to recover soon, given the pressure that they have on some parts of their business coming out of the pandemic. But long term, this is still a great company and is a stock that I look to accumulate over the next year or 2. Thanks for watching. Please remember to subscribe to the Rive Project. Hit that like button. And if you have any questions or comments, I'd be happy to discuss those below. And I will see you back here next time.